That's why they say that Warren Buffett pays less in taxes than his secretary, his effective tax rate. My philosophy is I'm going to invest enough into retirement accounts, invest enough into the future. If you want to retire early, you're going to need to contribute to this account. If I lose all my real estate, I'm going to be fine because I'll still have those retirement accounts. Hey, welcome back to the Learn Like a CPA show. I'm your host, Ryan Bakey, and today we're going to be talking about the most underutilized form of investing account that you can have, especially as a real estate investor, more so as someone who is trying to retire early or to make work optional early. At this point, if you have been following the content, you probably have heard me talk about traditional IRAs, traditional 401ks, Roth IRAs, Roth 401ks, and how they all intertwine with real estate and kind of the steps that you have to take in order to progress into being a real estate investor. A lot of people ask, well, Ryan, what do you personally do? And my investing strategy is going to be a little bit different than your investing strategy. And so that's why personal finance is personal. But my philosophy is I'm going to invest enough into retirement accounts, invest enough into the future. So that way, if I lose all my real estate, if I lose all my businesses and they all crash and burn and China takes over the United States or whatever reason, I'm going to be fine because I'll still have those retirement accounts. I will have enough wealth by the time I go to retire that I don't need business or real estate. And so for me, that's $1,000 a month into one of these accounts, whether that's a 401k, IRA, or this new account that we're going to talk about, a taxable brokerage account. So a taxable brokerage account, you might have it already. You just don't know that that's what it's called. But you might have TD Ameritrade. There's Robinhood. There is Fidelity, Schwab, Vanguard, all these different types of people that can hold your investments. And with a taxable brokerage account, what's important to understand is that there is not a income limit that you can make to invest in a taxable brokerage account like there is an IRA or 401k. So with a taxable brokerage account, there's no $6,000 a year max. There's no $10,000 a year max. You can contribute as much money as you want to this account. This account is going to be an after-tax account, which means you're going to go to work your W-2 or your business. You're going to pay taxes on that income, and then you're going to contribute to the taxable brokerage account. So there's no limit on how much you can put into that account, and it's a taxable brokerage account. The best part about this account is there's no penalties on early withdrawal. So if you deposit money into this account on January 1st and you wanted to withdraw it later on in the year, there's no penalty. There's nothing that says you can't withdraw that money early, unlike an IRA or a 401k. And so this account really is a flexible account because you're setting yourself up for the future, because at any point in time, you can always draw on that account. You can always pull money out of that account and not have to worry about paying any penalties. So we already said that there's no cap on the amount of income that you can contribute to it. There's no penalties on early withdrawal. But what makes the account so advantageous is the tax efficient gains, because this account is considered portfolio income. And if you are one of the members of my 365 tax strategy service, you probably heard me say that portfolio income is one of the most tax advantaged incomes next to real estate income, because number one, we don't pay any Social Security or Medicare taxes on that. So if you're working at W-2, go pull up your last pay stub. You'll see a line that says Social Security, and you'll see a line that says Medicare. And that's an extra 7.65% that you pay tax just to work. But in taxable brokerage account, portfolio income does not have that same tax. So right away, any money that you make inside of this taxable brokerage account is more tax efficient than if you were to show up to work and make it. But the best part about the brokerage account is that there's tax efficient gains, because anytime you have a stock in that account that's held for at least a year, that's going to receive capital gain tax treatment, which means you're taxed at 0, 15, or 20% based on where your tax bracket is. And so how tax brackets work is that your income stacks on top of each other, kind of how water and oil mix together. They don't mix well. So you have water at the bottom, oil goes on top, the water being your W-2, your business income, et cetera. And then any sort of capital gain income goes on top of that. Well, your W-2 income is going to set the standard for your capital gain tax rate. And now most people, if you're listening to this, you probably fall in the 15% capital gain rate. Most people do, unless you're making, I would, $500,000 or more, married. And I want to say maybe 300 if you're single. You're going to be in a 15% capital gain rate. So right away, think about that. If I make $100,000 in my taxable brokerage, like let's say I invest that money, and over 10 years I earn $100,000 in that account, I'm only paying 15% taxes when I go to withdraw that account. Versus if I'm in a high tax bracket, I might be paying 35, 37% on the money that I make at my W-2 or my day job, but I'm only paying 15% inside of that taxable brokerage account. So it's much more advantageous when I talk about shifting your income, when I talk about getting, instead of being a W-2 or a self-employed person, being an investor, being an owner of stocks, being an owner of real estate, you're really shifting your tax bracket. You're shifting how you make your money, because remember, it's not about how much money you make, it's how you make the money. If you are making all your money through portfolio income, like a taxable brokerage account or a real estate portfolio which is passive income, you can have a way lower tax bracket than somebody that's only making their income at W-2. That's why they say that Warren Buffett pays less in taxes than his secretary. His effective tax rate. It's not that he pays less in taxes than his secretary. Let's be honest. He's got, payroll taxes. He's got state and local taxes. He's got all this type of stuff. But the amount of tax that he pays on his income relative to how much tax that his secretary pays on his or her income is a lot less. And that's what I'm trying to get you guys in the mindset of, is shifting your income from that W-2, that high tax bracket, into the portfolio income through a taxable brokerage account or rental real estate passive activities. And so how these kind of work and play in together is you are taking money from your high tax bracket and you're shifting that to these buckets over time until eventually all, if not most, of your income is made up of either passive income through real estate or a taxable brokerage account. Let's get back to the taxable brokerage account.
Real quick, guys, if you could think about how you found this podcast, maybe it was on Facebook, Instagram, maybe somebody shared it with you. I don't run ads for the show or have sponsorships, so the only way this grows is through word of mouth. If this was valuable for you in any way, the only ask that I can make is that you share it with somebody else. Pass it on to the next person whose investing journey or business can be changed by listening to the show. Much love, guys, and let's get into the episode.
Let's get back to the taxable brokerage account. There's also tax-free or tax-incentivized investments that you can make inside of the account. For example, like they'll have state and municipal bonds, which are normally tax-exempt or tax-free. Sometimes you have bonds that do not pay. They're not taxable, like municipal bonds. Now, typically, these bonds, they're considered interest income, which interest income is normally taxed at your regular tax rate, right? 30%, 35%, 20%, whatever I'm at. But if I have an interest-free bond inside of my taxable brokerage, I actually don't pay taxes on that bond. So a lot of people like to invest in these, what they call muni bonds, because they're tax-free at a federal level. Now, just realize that normally, if you're investing in any type of investment that's tax-free, they typically have a little less of an overall return or a little bit less cash flow, because you're making it up for it because you're not paying taxes. So sometimes these tax-free investments may not provide you as much cash, because the way that they're structured, you're more incentivized because you come out ahead by not having to pay 30% tax on that income. What's also not talked about enough is, and this might be a little too complex for some people, but hey, hang with me, is this idea of what's called tax loss harvesting. So tax loss harvesting is where maybe you have inside of your brokerage account, maybe you have some stocks or holdings that have skyrocketed in value, that have super appreciated in value, and you want to go sell those. Well, you have a capital gain on the difference between what you bought it for and what you sold it for. And so if you might have a capital gain, well, if you have part of your portfolio that has a loss, okay, in the same year, you can sell the loss. You could sell the taxable brokerage account portion that has a loss to offset the portion that has a gain, okay? And that's what's called tax loss harvesting. If I have a gain from one side of my portfolio, but I have a loss from another, I can sell them both and net them together, net them out, as long as my loss is equal to my gain. Now, what you want to be careful of is what's called a wash sale rule. So if you sell a stock for a loss, you're not able to buy back that same stock within 30 days because you wanted to harvest the loss. So be careful about the wash sale rule. I'm not going to go into it on today's episode, but the wash sale rule, just make sure that when you sell a stock at a loss, you buy back not the same stock, but a different company, maybe in the same industry, but just a different company. Okay. So that's tax loss harvesting. You cannot tax loss harvest inside of your IRA or your 401k, right? So if you have an IRA and it lost value, there's no such thing as tax loss harvesting. There is Roth conversions that we've talked about before, and that I will also probably do another podcast on today. There's going to be Roth conversions that you can do, but inside of that taxable brokerage account, you can do tax loss harvesting. So I've seen clients personally do this where they might have losses from real estate, capital losses from real estate. Like let's say they bought a property, they sold it, they lost money on it, unfortunately, but they have gains inside of their brokerage account. They could sell the gains from the brokerage account, and because the rental losses are lost capital gains, they can use those capital losses to offset their brokerage income, or vice versa, right? Like maybe you have losses in your stock portfolio and you're going to sell those at capital losses and you have capital gains inside of your real estate portfolio. Those two will offset each other. And so that's what I'm saying. That's the power of shifting your income into these other types of buckets, because these buckets will all net or offset each other. It's an amazing thing. You know, I talk about the flow of money. Okay. So the flow of money goes like this. You're going to make the money at a W-2 or earned income at your business. That's where you're going to be paying the most amount of money in taxes. And we can help you, not pay as much in taxes on that, right? Through 401ks, HSAs, have more babies, short-term rentals, buy real estate, right? There's ways you can offset your W-2 income, but you're shifting that income from that high 37% tax bracket down to your portfolio income where you're maybe only paying 15 or 20%. And then into real estate, where most of our clients, if not all real estate investors, should be paying 0% on their rental income because of the way that the tax code is written. So the name of the game is how quickly can you move your money from those high tax brackets in the W-2 over to your portfolio bucket, 0, 15, or 20, or to the real estate bucket where most people are paying 0%. The last thing that I want to talk about with the taxable brokerage account, and I'm kind of killing two birds with one stone here, is that you can actually take out loans against a portfolio. So if I have built up this huge taxable brokerage account, let's say I have $2 million in a brokerage account, I can actually take out a loan against the value of that brokerage account, and I'll get a cash loan. So I might have a $2 million balance in my brokerage account, let's say. I can take out a $1 million loan from that account, and I'm going to have to pay interest back to that account. It's typically like 5 or 6%. And then I could take that money and go buy a real estate deal all cash. Then I don't have to pay a 7%, 8% interest rate and pay closing fees and lender fees, et cetera. Like I can borrow against that brokerage account. Remember, when you take out loans, they're not taxable events, but I can borrow against that brokerage account. Instead of selling it and recognizing capital gain and losing some of it to Uncle Sam, I can borrow against that account and use it to go buy real estate. So just another pro of the taxable brokerage account. The one con to the taxable brokerage account that I want to talk about today is...
Hey guys, just wanted to interrupt the podcast today to let you know about my Facebook group, Tax Strategies for Real Estate Investors. We have over 6,300 real estate investors in the community actively engaging every single day. You're going to learn all my top tips. You're going to get to network with other professionals, and you're going to get to see all the past recordings and all the past posts in that Facebook group. So make sure you join today. It's going to be linked in the podcast below. And now back to the show.
The one con to the taxable brokerage account that I want to talk about today is the flexibility of the account. So earlier I talked about how you can buy in whenever you want, you can sell whenever you want. That being a pro, in my eyes, it's also a con. And the reason being is because when you have that account, you have access to that money, and you see the stock market go up and down on a roller coaster, you might be inclined to jump off. The only person that gets hurt on a roller coaster outside of the 0.00001% of people that actually get hurt on them is the people who jump off the roller coaster, right? If you don't have that disciplined mindset to stack that money in that account, to save, to invest it, you're not going to get scared when the market goes up or down 5, 10%. But you want to have that long-term mindset in mind whenever you're investing in real estate, whenever you're investing in your taxable brokerage account, because those are the people that really get hurt. I hate to say it, but I saw people during COVID, family members even, that they sold everything. When the market went down 30% during COVID, 25, 30%, they sold everything. They liquidated their portfolio. And what do you know? A year later, it was back up. And not only was it back up, it was actually more than what it was before COVID. So You just have to have the long-term investing mindset whenever you're dealing with real estate, whenever you're dealing with your taxable brokerage account. And if you want to implement these strategies, because the people that pay the least amount in taxes are the people that own assets. They either own stocks, they own real estate, they own businesses. And those three things right there are a long-term game. You have to have a long-term mindset for those. So that about wraps up the podcast today. We talked about the taxable brokerage account and how it really is this flexible wealth building machine where if you want to retire early, you're going to need to contribute to this account and you're going to need to stack cash into this account, your IRAs, your 401ks, and real estate. So this is just another vehicle that I want you guys to use, or I want you to use in order to build wealth. Thanks for tuning in to the episode today. If you want to learn more, check out my Facebook group, Tax Strategies for Real Estate Investors. We have over 8,400 real estate investors in that group, posting daily, interacting daily, and we would love to have you there.